In this video, I'm going to be going over when to exit your trade for a win or a loss. Let's go right into the video. So something I see with a lot of new traders is they don't know when to take profits and they don't know where to put their stop loss or when they should exit a trade. So let's just jump into think or swim. I'll show you a couple of examples of some trades I took and what I would do and how you guys should move forward with your trading. So if you guys are new to my channel or if you guys have seen me in the past, you might have seen my video I made about going long on NVDA down here at about 134. I gave my reasonings why I thought NVDA was a good long right here and all the technical analysis and patterns I was seeing down here. Now this trade started off pretty good. It made its way up to this gap fill at like 145. Then CPI came out around here on September 13th and it destroyed the position. I pretty much cut for a loss of about like 30 to 40%. I didn't even have to panic about it because like I told you guys in the video, I had well-defined risk. My stop loss was below the lows at 133 and these were the previous 52-week lows. So the second I broke these lows at 132, I just cut the trade right here. I didn't even need to think about it, you know. But for some people, they'll see they're breaking these lows right here and they'll keep on holding the trade. And that's because they didn't have a defined trade plan. And that's why you need to go into each and every trade with a defined trade plan, knowing exactly where we're going to take profits and exactly where your stop loss was. And on this trade, for example, in the video, I mentioned in the video, I was looking for this gap fill before I even thought about taking profits because from a risk reward standpoint, so I entered around down here. So from a risk to reward standpoint at the time, this made sense. You know, this is like a 4-to-1 risk reward if you made it up to the gap fill. I took multiple contracts, so I already knew once it got up here, I was going to start scaling out my position because the contracts were for November, I believe, November, October. So once I got up to this area, I started taking profits and scaling out my position. And lots of people I see don't have proper risk reward or don't know how to calculate their risk reward. So the second they go up, 10%, they're cutting right here. And this is barely like a 1.5 risk reward, or it's barely 1-to-1. So from a risk reward standpoint, it doesn't make sense to, scale out right here. So this is why each and every trade, you need to have a fine stop loss. First take profit, second take profit, third take profit. So for me, like I mentioned, I was looking to scale out my first contract up here on the gap fill. I was going to trail the last contract with a trailing stop and it's right higher and higher. But it never made to that first take profit. So I broke below my stop loss. I just cut it right there. I have to think about it. All right, now we're looking at Tesla right here on September 16th. And something I always talk about too is key levels. Tesla hit lows down here at 266 and just kind of grinded its way higher up and up until 314. Now, some people take calls right here. Their stop loss is below here, so they have a decent risk reward. But then the second they go in the green, they just cut for literally no reason. So I'm always looking to take profits or scale out or at my Q levels or enter trades at these areas. So for example, if I entered a trade down here at Tesla 300, my stop loss would be below this region here, low of day, where we got in this trade. And my first take profit for the day is going to be up here around 314 because I know, let's check out the daily chart real quick. If I take calls down here in this region around 300, I know this area of 314 has been a pretty big level for sellers to keep rejecting the holding price below. So it doesn't really make much sense to keep trying to hold through this level. So if I'm taking calls, I'm looking to scale out into strength around the 314 area because I know historically going back to February, this 314 level has been rejected, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times. So instead of looking for the breakthrough or the breakout above this level, I'm looking to scale out and secure my profits into strength rather than, getting hit with a nasty pullback into this level, even though you guys should have known this rejection was coming because it's been rejected 9 times in the past year. And one more example here, looking at AMD. So we took AMD puts on the breakdown, this 52-week low around $71. Now, if you look at the weekly chart, AMD is breaking below this key level, and the next level really is $60. So if I pull up the volume profile pretty quickly, you guys will see, you're entering this huge volume void. You broke the 200 weekly moving average, and the next, key level is going to be down here at $60, which is also a psych level. So zooming back into the 5-minute time frame. And this is why, once again, goes back to having a trade plan. If your plan was to scalp AMD, first of all, it's not really that big of a mover. You can make money on it, but you have to understand the equity you're trading. AMD isn't a fast mover, so you can't be expecting, 100%, 200% returns in one day like you would on like Tesla or Amazon or SPX. You have to know what kind of equity you're trading. So going back to AMD, so breaking down below this key level here at $72, yeah, you could have scaled out on this way down, but because of the technical analysis we just saw, there's really nothing in this area till around $60. And this is why having a trade plan. I got the November 18th puts, the $60 puts, because I know that AMD is going to take a little bit longer to play out, and I want to give myself time on the position. So instead of seeing like a little bounce like this around $67 while the stock continues to make lower highs, I'm not going to panic on a little dollar bounce on here because I know I have 2 months left in the contracts, and that's just part of my trade plan. I knew I'm going to stop out above this region right here, and I know my total reward is down to $60, so I don't have to panic about it. I have a clear, defined plan, so there's really no stress in this trade. And this is why it always goes back to having a trade plan. Once you guys start taking trades off key levels or using supply and demand, it gives you really defined risk, and you know exactly where you need to stop out, and you know exactly where to look to take profits. You know, there's no guesswork. It requires no emotions. You're just reading the chart, letting the chart tell you what to do. Now, if AMD were to start spiking below $72 and, you know, buyers step in, then you have to start looking potentially to close out my position. But I'm not going to panic here. I have time on my contracts. I know I have to give this stock time to let it play out. And that's why in my trade plan, I gave myself 2 months on expiration rather than a weekly contract, because I know it takes time for AMD to move, and I might not get this move all in one day. So if this video helped you, or if this gave you a better understanding of when to exit, when to take profits, and setting your stop loss, just drop a like and comment below, and stay tuned for the next video. Thanks for watching.